so much for joining in. We'll talk about the markets at large, but what does an investor do when he looks at a stock like RBL Bank and the way it's fallen? I mean, the last 2 days it's corrected over the last 1 month. Let's say you had it in your portfolio. If you're unlucky enough to have it in your portfolio, what would you do now?
Thanks, Neeraj, for giving me this time. Now, coming to RBL Bank, talking from any investor, whether it's a long-term, large, small investor, price volatility becomes a bigger concern. That's where the problem with RBL Bank. When something falls the way it falls, as we have seen with RBL Bank, and as Manoj rightly said, even traders, investors, they don't have the appetite to take such extreme volatility.
Sure.
So even if something is cheap relatively, you will want to wait and watch before entering it. Even a long-term investor will think twice, because you don't want to see another 10% down in this market when you have bought it thinking it's cheap. This is the kind of trap where people have got hurt badly in the past. Yes Bank, India Bulls, Diwan Housing, there are many names where you really don't know what's happening at the corporate level. And unless you know that, you stay away. And this creates a demand-supply mismatch. So even if I want to buy it in my portfolio because it is cheap, I will have to wait it out till the carnage is over. And if it's a quality stock, which I hope in RBL case it is, then whenever the bounce comes, it will be as sharp as the fall is. But if you ask me as an investor or as an advisor, I will stay away from the stock for now. So there are two aspects to it. You rightly said that at this point of time, investor interest will be more on the gold financials or in terms of NBFCs over asset financials because of two reasons. One is on the liquidity issue. The cost of fundraise for these NBFCs have gone up drastically, and with the demand slowdown being talked about in the economy in terms of corporate, their ability to pass on the interest rate increase which they have faced on the liability side, on the asset side, is low, which means their NIMs and earnings going forward will be under the stress. In this scenario, people tend to prefer gold finance because not only gold has gone up by 6 to 8% over the last few weeks, these guys being the kind of secured they are, their ability to raise funds is much higher. Keeping that in mind, we at Sonora really like Manappuram Finance. If you look at it, it's trading near the lower, it's below the mean valuation in the past. It's around 1.8 times book. The kind of growth its MFI business is doing on the in terms of Ashirwad, it's quite good. While their gold loan sequentially was slightly lower, but their asset quality and their NIMs was much stronger than Muthoot. Now coming to Muthoot and Manappuram, if you look at it, Muthoot trades around 2.2 times price to book 1 year forward, while Manappuram would be around 1.8. Keeping Ashirwad in mind, I think Manappuram will outperform Muthoot in terms of growth, NIMs and everything, and hence this gap is kind of unwarranted. So in this correction, in this market scenario, we believe that Manappuram can give good returns to investors from a 6 months to 1 year perspective.
Okay. What about the other financials? Now, I think this earnings season has shown that if you bet on the tried and tested, you've not lost money. I mean, the others, a lot of them have corrected very strongly in the quarter. For one bad quarter, DCB Bank, for example, strong bank but is corrected. In light of that, would you prefer betting on the larger names, Kotak HDFC, or would you prefer for maybe the slightly better price names like ICICI Bank and Axis Bank?
So when the markets are such volatile, Neeraj, the first thing you have to look for is margin of safety as an investor. Where can I hide and where the carnage can be lower? I'm not saying that I don't like HDFC Bank or Kotak Bank. I really like them. They are safe havens. But where will you make money? Those stocks will continue to grow the way they are. Those stocks are already fairly expensive or fairly priced in. Whereas the ICICI Bank and Axis Bank are trading at sub-2 book. Now both are considered corporate banks. But if you look at their loan growth over the last 3-4 quarters, ever since the new management has come in, it's more on retail side, which means the mix over the next 2-3 years will change drastically for these guys. Now, which retail-focused bank with this kind of quality and this kind of franchise trades at such multiples? Even in the toughest of times, a retail bank doesn't trade at sub-2 valuation. So as an investor, I find a lot of value in ICICI Bank and Axis Bank without worrying about the quality of the book being there in terms of the past. Those books are there, and those devils will come out if the downgrades and defaults continue, which for me as an investor is an opportunity to buy. Now, as a trader, you'll ask me that, am I compulsive to buy? The answer is no. But I will look to sell something like IndusInd Bank. It trades at around 2.3 price to book, which is 20-30% higher than Axis and ICICI, with Mr. Sopti's renewal being in question. And we saw what happened to Yes Bank when Mr. Kapoor went. Now, IndusInd Bank has huge exposure to CVs. They themselves announced that they have around 2% exposure in terms of loan to NBFCs like DHFL, AD.
And they did
Group.
not classify some of those accounts.
Exactly.
They kept them as standard accounts
Exactly.
in this quarter.
So earnings distress will come there also. Asset quality book issues are there also. Then why should it trade at a 30% premium to something which has a better franchise? And the management of ICICI and Axis are pretty good. They are focused on the ROEs, the ROAs, the quality and the growth and everything, which are the right takes in place. Axis Bank, with a slightly negative quarter, corrected more than 10%. I think it's a very good opportunity for someone to buy it. And in this fall, even ICICI has corrected by 8-9%. It's a good entry point for investors.
Okay, that's the view coming in on these private banks.
Valuations are similar to what were in the 2016 down cycle, 2009 cycle as well, on the EV/EBITDA basis, a very close price to book as well. Do they provide an opportunity, or is it too volatile? JSPL, for example.
So I will look at a better name like Tata Steel. I think it's better to discuss that from an investor point of view. Tata Steel is now trading at, as you rightly said, the last down cycle lows in terms of valuation. It's trading at a replacement cost to the Indian business. But what you have to understand is these commodities are more driven by the global parameters. The US-China trade war has kind of egged the whole commodity cycle. Now, with this war continuing, there's a lot of question about dumping of Chinese steel in India and stuff like that. What it does is it takes away the pricing power from the Indian players. Until the government does something which the industry has been talking about, even a value investor will not come into the picture, because you don't know where the valuations will be, because the earnings are very, very volatile. So a cyclical industry like commodity, like steel, they trade on the way the earnings direction are. Multiples really don't matter beyond the point. So if the earnings is on the up cycle, they will continue to give you fantastic returns. When the earnings is down cycle, every cycle they will look cheaper to you. So I will wait for the US trade, China war to settle, global commodity prices to settle before even considering them for investment or trading, either side.
Okay. Do you like the consumption names? Paint companies, jewelry companies, any views?
So we like Titan among the consumption names. We like Titan because if you look at it, Titan has corrected post the numbers because they guided for a lower growth. Now I'll take you back a bit in the history. Sometime last year when it was trading around 750 odd, it did the same thing. It said, I'm seeing a tough market. I really don't know will festive season bring the demand to me or not. And we saw a 10-15% correction. We have similar trade now. So my sense is it all depends on if they see some consumption, some demand in the upcoming festive season, you will not get these prices again. Whereas if they don't see that kind of a demand, they might correct by 5-7%. So as an investor, I see a lot of value here. I see a good risk reward here.
Is valuation a concern?
It's still higher than the historical mean, but really not on the higher end of the valuation. And it's a consumption business, cash generating, market leader. I really don't think I'll risk too much of my capital here if I'm investing.
Okay. Similarly, like Asian Paints as well. Is that the better play of the paint companies, or the Bergers or some of the other smaller ones also fit the bill?
I think they effectively they move in the same direction. We recommended Asian Paints to our clients very heavily when it was sub 1300, when the crude was at around $80. I think with the positive surprise in the volume numbers of this quarter, what we've seen is the re-rating of the stock. For Asian Paints to sustain on this valuation, you need to continue to have the good volume growth. If they can deliver the volume growth, what will happen is this is one place for investors, large investors, to hide themselves. What it will mean is that will continue to trade expensive. This is a market in this volatility, this is a market where expensive will remain expensive and cheap will become cheaper, which is why RBL Bank, Yes Bank, JSPL are falling the way they are falling, because investors don't want to risk. Nobody wants to take a risk in a volatile environment. So my sense is Asian Paints is a buy on dips to me, but Titan is something which I'll invest and will add at